The Fed needs to cut interest rates, not at the September meeting as people expect, but next week. I've been in the higher for longer camp for a long time that the Federal Reserve need to keep interest rates up to battle inflation. But now we see that the economy is slowing, inflation's coming down. It's time for the Fed to move, because if they don't move, they're definitely going to increase the risk of recession. Well, we're seeing more softness in spending, especially for lower income households who are burdened by higher short-term interest rates on credit card debt and auto loans. Higher income households are still pretty well insulated because they have the benefits of a strong stock market. During the pandemic, there were large fiscal transfers from the federal government to households, both low and moderate income households. That put their balance sheets in really good shape. But now they've spent that extra savings. And so the lower income households are pretty much tapped out at this point. And so they're just stuck with the cost of much higher interest rates. I think the interest rates are really falling basically in two areas. Short-term interest rates are high, and that feeds into credit card costs. And if you pay your credit card bill off every month, you don't experience that. But if you're struggling as a household to stay current on your credit cards, those interest rates are very, very high. Another area is auto loans. Auto loan rates are much higher than they were a few years ago. And so when people have to buy a new car or buy a used car, they're hit with much higher auto loan costs. So the Fed has signaled pretty clearly that they're not going to cut rates in July. They're going to wait till September. Why are they being so patient? I think there's probably three reasons for that. Number one, I think they're worried about getting faked out on inflation like they were earlier this year, where they were very close to declaring victory, and then we got 3 months in a row of bad inflation news. So they don't want to make that same mistake again. The second reason is I think Chair Powell wants to have a strong consensus among the Federal Open Market Committee when they do cut rates. So by waiting a little bit to get the hawks on board for a September cut, where maybe if he tried to push it through in July, he'd get a few dissents. And finally, I think the Federal Reserve is less worried than I am about uptick in the unemployment rate. The unemployment rate's risen by about 0.5% between now and last year, and we're getting very close to puncturing a threshold that every time you've gone above that threshold, you've actually ended up in a full-blown recession. Fed officials argue that this time is different because the rise in the unemployment rate's been driven by rapid growth of labor force. But if you go back to the 1970s, we had very rapid growth of the labor force. This threshold turned out to be a very good predictor of future recession. So the risk of dawdling is that the unemployment rate keeps going up, and we get to the point where the process becomes self-reinforcing. Higher unemployment causes people to cut back on spending. As they cut back on spending, that leads to more job layoffs. And the cycle continues until you're in a full-blown recession.